Okay. So welcome back once again, and I welcome you into this video. Good. So now the next thing we are going to talk about is liquidities. Now, what is liquidities? In forex, or in the forex market, liquidity pertains to a currency pair's ability to be bought and sold without causing a significant change in its exchange rate. Currency pair is said to have a high level of liquidity when it is easily bought or sold, and there is a significant amount of trading activity for that pair. So you get it. If the currency pair is being sold and there is no much effect on the currency or the exchange rate of the currency, that means the currency has a lot of liquidity. Okay, so if a currency is sold, or a company, or a hedge fund bought a currency pair, and the pair moves extremely high than expected, I mean the liquidity is very low. Okay, but if they buy it and still the pair stands, or the pair is still stable, it shows you that the liquidity in that area is very high. Okay, let me give you a real life example. Now, assuming you want to buy let me say 3 iPhones. Okay, you want to buy 3 iPhones from Apple shop. Okay, but when you go to the Apple shop, they only have one, but you need the three. Okay, unless you get someone who is selling the additional two outside the shop before you can meet your order, which is 3 iPhones. You get it? So when you want to buy, there should be somebody who is ready to sell. And when you want to sell, there should be somebody who is ready to buy. Remember, I said this forex market is buyers and sellers. Okay, so this is what causes liquidity, or this is what liquidity is all about. You see, we have the big boys, or the people who have a higher volumes. I'm not talking about individuals, I'm talking about the banks, I'm talking about companies like hedge funds. Okay, they have billions of dollars. So when they come to the market without enough liquidity, they will move the market insane, which shouldn't be happening. It affect the country's economy, okay, or it will affect the market significantly. So they need a lot of liquidity in the market for them to fulfill their orders or to meet their orders. Let's say a bank want to buy Euro CHF. Let me bring the watermark so that you can see that we are talking about Euro CHF. Good. Okay, so let's assume a bank or a hedge fund wants to buy Euro CHF. Okay, there should be people who are ready to sell the Euro CHF before they can buy. Okay, now let me get you back to the real life. Now let's say you've gone to the Apple shop, you want to buy three. They have only one. You go outside to find the other two, you are still not finding. The other way to be able to meet your order is persuade someone, okay? To persuade someone who is having the iPhone, then you buy. Or to trap someone, let me use the word trap or persuade someone who is having the additional two, okay? Who is having the additional two for you to buy it from him or her. Okay, so now let's come back to the market. So these big boys or these big institutions who have higher volumes, when they want to sell, okay, when they want to sell, they persuade the buyers to buy, or they persuade the buyers so that they buy from them, or they print certain patterns in the market that other people will see that, oh, we have to buy. The market is about to go up. We have to buy. So when there are enough buyers in the market, then they sell. So what they print and what they print before they get their order, or because before their order is fulfilled is called the liquidity. Okay, the same thing. If they want to buy, they print something in the market that will the retail traders. I've already explained the retail traders to you. We the individual traders and Mr. Tam, the newcomers. We the retail traders, the big boys, they print something in the market when they want to buy. They print something in the market that we think, oh, the market is going to sell, so we will sell. Okay, immediately we sell, then they buy. You get it? So here we have buyers and sellers, so the orders is fulfilled. So that is liquidity. Anything that the big boys print to persuade the retail traders are called liquidities. They are traps. Okay, so they will print a certain pattern. You think that, oh, this pattern from the retail concept is, concept, or the newbies, or for the beginners concept. You think that, oh, when you see this pattern, the price is about to go down. When you see this pattern, the price is about to drop. Okay, so you try to sell. Immediately we try to sell, then the big boys or the institution, they buy. That is liquidity. So we have a whole lot of liquidities. When you are coming, I know a lot of you know about this things. When you are coming, you thought about this double top, you thought double tops, double bottoms, you have uh, another one is equal lows, equal lows, sorry, equal highs, and then we have equal lows. Equal lows. We have trend line liquidities, trend line liquidities. I will label all of them and explain everything to you, so don't worry, just follow me. We have trend line liquidities. Okay, so this is the trend line. The trend line. Okay, so let's go here. Here is a double top, double top, double bottom, equal highs. Sometimes they are not almost equal, they are relative equal highs. So it is a liquidity. Okay, so let's go. Then we have this equal lows. So these are the we will go to a lot of them. A lot of the liquidities, and something like, let me add this, triple bottoms, triple bottoms. This is very important, so you need to watch the video more than once. Okay, so you guys need to watch the videos more than once, all the videos. Okay, so as I said, just follow me. I'm going to label everything for you. So I said this is double, this is double tops, double top. I said this is double top, this is double bottom, bottom. Thank you, Grammary. They have spelled everything for me. Okay, so this is equal highs. This is equal highs. This equal highs. And this is equal lows. Equal lows. This is triple bottom. Oh, this is triple bottom rather. And this is triple top. Triple tops. Tops. Equal highs. Okay, so this is double tops. Let me do my sentence ready. My English teacher may be watching the video, so guys, let me allow Grammary to help me. Now this is trend line liquidity. Or let me use the proper name, trend line phantom. Trend line phantom. It is a liquidity. Good. I'll talk about the rest, but these are the most powerful ones. These are the most powerful liquidities. So whenever these are liquidities, okay, these are liquidities. Whenever you see a liquidity, bear it in mind that the market will trade to that area. I repeat, whenever you see liquidity, bear in mind that the market will trade to that area. So let's say in a bullish market structure, something like this. Something like this. And you see a double bottom here, then they go. See, you can see that there is a BOS here, and there is a BOS here. I'm making everything simple for you. You can see that we have a BOS here, and this is the last lower low. Okay, let me bring my box back. You can see that, oh, nice. So we can see that this is a POI. This area is a POI. Okay, we are in 4 hours, so let's label them. This is a POI 4 hours. Can we teach you something? Okay, this is a POI 4 hours. It's also a POI 4 hours. You see, this POI won't hold. This one won't hold. This one will hold. Okay, and sometimes they use just a wick. You see, when they break this, when they break this with when they break this last higher low, it means that they are confirmed bearishness because this is a bullish market. Obviously, this is a expansion, retracement, expansion, retracement, then expansion. Okay, so when they break this last lower high, it means that they are confirmed bearish. Okay, bearishness is confirmed. Now, I told you if you buy here, you will hit your stop loss. Why? Because there is a double bottom liquidity here. hope you all can see. Very, very clean one. There is a double bottom liquidity here. So liquidities, they are monies, because when you see double bottoms from the retail trader side here, you should buy. Okay, you should double bottom like this, you should buy. Okay, and so they will buy here, they will buy right here. Okay, and then they place their stop losses here. Remember, stop losses are money. Okay, so I use this dollar sign to represent liquidities. Good. So this is what the market makers will do. They will come and clear these liquidities because they want to sell. Okay, they want to sell. If they want to sell, they will print these double bottoms for you. Okay, for you to buy. When you buy, or when they have a lot of buyers in the market, then they sell. So you see that your trade will hit stop loss easily. Sometimes it will go. They can go here and then come again and clear it. But me, whenever I see liquidities like this, I don't buy. Okay, I wait for them to clear the liquidity. Then this is the area, the second POI here. This is the area I'll be looking for my buys. Okay, again, if they use body to close above this, okay, they use body to close above this. Sorry, they use body to close below this. I won't buy here. Why? Because this is the last lower low. Okay, this is the last lower low. So if they close below it, they've changed to bearish. Okay, they've changed to bearish. Now let me teach you one thing. Whenever they want to change from bullish to bearish, they always print liquidities at the BMS. They print liquidity. So you can see that this is the last lower low. So the last lower high. So the market should come here and then goes up. But because there is a liquidity here, they will break the structure and then start forming this. Start forming this. Okay. So that is liquidity. That is liquidity. That is liquidity. So whenever you see that there is a liquidity below your POI, it won't hold. Okay, whenever that you see that there is a liquidity below your POI, either double bottom, double bottom, higher, equal highs, equal lows, it won't hold. Liquidity won't hold. This is for bullish. Like, let's do example for bearish. In bearish like this, sorry, my mouth is really disturbing me. Okay, in bearish, we have something like this. Sorry, let me draw it perfectly. Oh, my mouse. Sorry, guys. Let's move on. So in bearish, we will have something like this. Have something like this. So we have our liquidity here. Or let me do it like this. This will be better. Let me something like this. See, we have the bearish structure. Nice one. So let's label it. We have the BOS here. BOS here. Nice one. And then BOS here. Look, let's focus on the main structure. Okay, this is the tenor structure, but let's and then the BOS here. Okay, so this area will be a POI. This area will be a POI. This area will be a POI. But we are always interested in the immediate POI. And then you can see that there is a double top here, which is liquidity. So let me delete this POI so that the liquidity will be clear. And double bottom top here, which is a liquidity. So let's bring the liquidity symbol. Okay, so this is This is the liquidity. You get it? So this is the liquidity. Guys, coming. This is the nice one. So this is the liquidity. Okay, we have the liquidity here. This is the liquidity. So let's move on. We have the liquidity over here. Good. You see, I've told you that we're supposed to sell from here. Okay, we're supposed to sell from here, and then our take profit will be here. When you see that we are retracing, so we sell here, then it comes down. But because of this liquidity, this POI won't hold. Okay, this POI won't hold. And whenever we break this, we should expect bear bullishness, because that was the last lower low. Sorry, that was the last POI. Okay, when you break the last POI, you should expect a change in structure or a break in structure. Some call it BMS. You see some people calling it coach, CHOCH. That is change of character, the same as BMS. So don't confuse yourself. Whenever there is in bearish market like this and there is liquidity above your POI, the POI won't hold. Okay, so let me continue the labeling. We have our BOS here. We have our BOS here. And then our POIs, but because of this liquidity, it will move. So in bearish market structure, when this liquidity above your POI, your POI will not hold. The same thing in bullish market structure, there is a liquidity just below your POI. Your POI won't hold. Okay, so this is what you need to know about liquidity. And remember, I told you all these things are liquidities. All these things are liquidities. All of them. Okay, all of them are liquidities. So, and one thing, when we get to the other blocks, I will teach you this thing. Okay, so let's move on. Now, some of the liquidities, some of the example of liquidities are fair value gap. Let me teach you this. Other examples of liquidity is a fair value gap or imbalances. Remember, I told you that when the market is moving, it leaves imbalances here. So it retraces to fill those imbalances. If not all, some of it, then continue the bullishness or continue the expansion. So it comes back to fill the imbalances and continue the expansion. Okay, so let's do this. Let's assume this is a candle. I'm going to teach you something, so please pay attention. Just follow me. Another candle here. Sorry. let me bring the rigs. Please pay attention. I'm teaching you very, very important thing. So you need to pay attention. Pay the utmost attention. So let's see. Let's go here. Oh, okay, so guys, pay attention what I'm teaching you. Good. So this is scenario A. Let me label it. Scenario A. Okay. So we have scenario A over here. Good. Now let's move to scenario B. I'm teaching you imbalance, rare imbalance. Some people call it fair value gap. They are all the same. Okay? Some people call it fair value gap, imbalance. They are all the same. Let's say this one, the rate. Okay? So they are all the same. I'm done. Okay. So you can see, if you don't know, you will say there is no difference in scenario 1 and scenario 2, scenario B. So B. I think my spelling is correct. Wrong. Thank you. Good. So with scenario A, you can see that in between here and here, there is no space. So there is no imbalance, there is no fair value gap. Let me give you a clear example. You can see that from here and from here, don't focus on the middle candle. Let's focus on the last and then the first. You can see that from here to here, there is no wick. Instead of a wick to come here so that they will fill this space here, there is no wick here. You see that? So this place from here to here is what we call the fair value gap or the imbalance. fair value gap. Okay, from this week to this week is what we call a fair value gap. It's what we call a fair value gap. Okay, we can see that from scenario A, there is nothing like fair value gap. You see, the wick has filled all the space. There is no space in between here. There is no space. But here and here, with scenario B, here and here, we have the space. Okay, so this is also a liquidity, a fair value gap. Whenever there is a fair value gap, the market always comes to fill the fair value gap here and then push up. Okay, but here there is no fair value gap here. There is no in between here and here. The market has filled it. Okay, you can see that the fair value gap has been filled. But here and here is what we call a fair value gap. Okay, so this is also a liquidity. This is also a liquidity. So I've been talking about imbalances, fair value gaps. This is a fair value gap. We go to the rare market and show you example of everything. Now another liquidity is old lows, old highs. Okay, old lows and old high, monthly lows and monthly high. So let me add them to these liquidities. Another form of liquidities are old lows, but these are not strong. Old high as compared to what I just drew. Old highs. When I talk about old lows and old highs, I'm referring to monthly lows, monthly highs, weekly lows, weekly highs, daily lows, and then daily highs. Okay, good. So these are liquidities: double tops, double bottoms, equal highs, equal lows. Let me point them so that you know what I'm talking about. Double tops, double bottoms, equal highs, equal lows, trend line phantom, triple bottom, triple tops, old highs, and then old lows, and then fair value gaps. Fair value gaps, okay, and then fair value gap. This is what we call fair value gap. Let me take a picture of it. I think I can show it, or I can give it to take a picture of it and then save it. Take a picture of it and then good. So these are all liquidity. Now let's go to the rare market and then find liquidities. Let's go to the rare market and then find liquidities. Okay. Let me remove all drawings. Remove all drawings. I want an area where the market came to clear. Good. Perfect example here. Let me go and use the replay bar. Good. So what do we see here? There is a bearish market structure over here. A bearish market structure over here. Why? Because we have the retracement, expansion, retracement, expansion, retracement, expansion. But here, what do you see? Instead of it to form lower low, it didn't. We rather have an SMS. shift in market structure. Good. And we can see that there is a liquidity here. Relative equal highs. Liquidity, meaning the market will come to clear these liquidities. Okay. Market will come to clear these liquidities. Good. So the market will come to clear this liquidity. Good. So this is the last lower low because we have a BOS here. When we get to other blocks, all these things will be very, very simple. Have a lower low, lower low. This high, this high couldn't form a lower low. Okay, so it is not a valid point or a valid POI. Okay, when you get to the other blocks, you understand this thing, but you need to understand liquidity before you move to other blocks. And other blocks is the one that caused the BOS. This area couldn't cause a BOS. Okay, so we cannot call it other block. Okay, we cannot call it other block because it couldn't cause a BOS. So this area still become our point of interest. Good. So this area becomes our point of view. And since there is a liquidity up here, it means that the market makers will come and take those liquidities, trade into the POI, and then drop. Okay, trade into the POI and then drop. Nice. So whenever the market has a liquidity, it will go for the liquidity. Okay, the other blocks the final part where we take the trade. So everything will be combined, market structure, liquidities, all of them will be combined before we go to where we take the trade. That's the other block part. So just focus on the liquidity for now. You understand everything later. Good. So here, market, come here and then clear this liquidity. Good. Let's play and see if the market came. Boom. So you should have made a stop loss. When you have a proper confirmation, you understand all these things. So you can see the market play out successfully. The market play out successfully. Why? Because there is a liquidity here. So we knew that the market would definitely come and take those liquidities. You get it? And also this is the last point of interest, POI, 4R. So it takes the liquidities, come to the point of interest and then sell. So this is liquidity, assuming that there was a liquidity above this. Okay, let's assume that there was a liquidity here. Let's assume that there was a liquidity here. When there is a liquidity above this POI won't hold. They should have done something like this. Come here before maybe dropping. Okay, but because there wasn't any liquidity above this POI, that was one of the reasons why this POI was a valid POI, and then it hold. Okay, and then it hold. So guys, this is where we end the liquidities. Okay, this is where we end the liquidities. The next thing is I'm going to talk about order block, and then we move on to the steps of taking entry, or the steps of making money, or where you can buy or sell. So thank you very much, and then see you in the next video.